watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, Icicidirect. Very good afternoon and welcome, Pankaj.
Good afternoon, Gitu.
Pankaj, starting with markets, as you had suggested last week, Nifty went up to 17,700 levels, could not sustain about that, came a tad lower, but yes, overall the markets have remained positive, and the move has been on the higher side. So now, what is expected, for Nifty as such, the levels? Can we see some kind of a capping happening near 17,700 levels because we have been witnessing a selling pressure around those levels?
Absolutely. So on Nifty, we continue to maintain a very positive stance, and our sense is that while it might sort of consolidate around these levels, but shorter term 17,900 is what we have been expecting as a level for Nifty. And on the support side, you will have 17,300 acting as a strong support. And our sense is that there has been a higher appetite for riskier assets, given the fact that we've seen dollar index sort of closing below 50-day moving average. Similarly, in US, we are seeing some bit of a bounce. The falling trend line of Nasdaq has given a breakout. So from those levels, even the IT as a pack looks good. And our sense is that given the fact that overall risk appetite is better, volatility is lower, so emerging markets relatively will do better, and India within emerging markets stands a better chance. And which is why we are at 4-month high levels. And another interesting thing, what we figured is that there has been a golden crossover witnessed yesterday in Nifty and mid-cap Nifty. So from that perspective, whenever the 50-day moving average crosses a 200-day moving average, historically we have seen 8 to 9% kind of a move in 8 out of 10 instances. I mean, if I sort of extrapolate that, our sense is that in next 3 to 4 months, it will not be a surprise that probably Nifty could be at a new high, probably closer to 19,000 kind of levels. So I would want to sort of believe that the structurally markets are on a positive trajectory. Short term, we might see some bit of a consolidation at higher levels, but probably new high is on the cards for Nifty.
Pankaj, one thing is a miss for me because 2 weeks back we were talking about markets, going to 15,000, sub 15,000 levels also, and 2 weeks hence we are now talking about Nifty touching a new record high. So, what exactly has changed in the markets? What are the key triggers that are working for markets right now?
So what is obviously when you look at the riskier appetite globally is finding favor largely because the US inflation print has come out to be lower. We have India inflation number today also, and our expectation is that inflation will come down from say 7.1 to 6.8 or 6.7 types. So here also you will see a lower print of inflation. Now, obviously, Fed is still hawkish, signaling that in September they might still go for a 75 bips kind of a hike. And given the fact that job data there is still strong, but what is also sort of coming out is that there's some softness in the market or in some section of the market, whether you look at globally or domestically. So what this implies is that probably the level of hawkishness what central banks have been maintaining for some time to curb inflation, I think that will get tempered with over a period of time, and which again is positive for riskier assets, and which is why we are seeing metal, for example, as a sector being the best performing sector for this week. In general, equities are likely to sort of do better as and when the inflation sort of keeps cooling off. And our sense is that globally, since you have enough fears of recession, so energy prices are not going to sort of skyrocket the way things have sort of happened earlier. And somewhere down the line, base effect also will creep in. And as a result of that, you will see lower inflation print. And that will sort of cool off the inflation and probably less aggressive rate hikes, if not next policy meeting from there on onwards. So that way, I think you'll see a positive rub-off of all this on equities.
Pankaj, can we say that markets have digested recession too?
So recession definitely in US technically is US in recession because last 2 quarters has seen a negative GDP growth rate. Domestically not possible. I think domestically we are sort of firing almost all the cylinders. So that way I think domestically we don't see a risk of that. Globally, yes, things are a lot more challenging when we sort of listen to the overall con call commentary of various companies across various sectors. So from that perspective, I think India is expected to remain a sweet spot. And I think for the next 3 to 5 years, whether it is large caps and especially mid caps and small caps, I think can be in a sweet spot. And probably you might see one of the best wealth generating opportunities unfolding or about to unfold in the next 3 to 5 years for Indian equities.
Let's move on to the gas news, which we had that government will now divert natural gas from industries to city distribution. And this has led to the surge in two counters. The IGL, it was up 17% in last three trading sessions, and your MGL was up nearly 12% this week. So how do you see this news playing out for both the counters? Is the kind of momentum that we saw in both of these companies, IGL and MGL, now over, or you expect them to really, uh, you know, you know, be with the momentum next week also?
So one thing is certain that the energy prices are going to be higher both domestically and globally. But I think one of the fears which have been there and which we also have been sort of carrying is that if tomorrow India has to sign or renegotiate long-term contracts, probably the gas which is going to come in future will be a lot more costlier because there is obviously a scarcity of gas. So from that perspective, it was expected that the gas overall domestically will be higher, and that will probably have some kind of impact on the overall demand. Now, when we sort of look at what has changed, so earlier when you look at there is the domestic gas allocation to these CGD companies, the city gas distribution companies. Typically, you have IGL and MGL, and both these companies get 80 to 85% of their overall gas requirements met through domestic gas. Now, that allocation, the government has increased to nearly 94%. So, which means that they'll have to take less of imported gas, and that will lead to slightly better prices, and they'll be able to protect their margins, and may not, and this may not eventually hamper the demand. So I think it's a kind of a relief rally what we are seeing, and I don't think that we could expect similar moves going forward. And I think that is already in the prices, so which is why we have most of these two companies. We have got a hold rating on both of them.
Talking about metals, they did perform this week. There has been, a smart recovery as far as the metal counters and indexes are concerned. Do you expect this kind of a momentum to sustain? Because when we talk about global commodity prices, they are on a fall. So, what is your view in the metal space right now?
Metal is always a tricky sector in terms of outlook, but yes, there is some relief what we see in terms of recent days. So one obviously is the overall quarterly numbers have been pretty robust. So when you sort of look at Hindalco's number, Hindalco, the domestic EBITDA per ton was quite high compared to what we have been sort of penciling, largely because of the lower cost inventory what they've been carrying. I think Coal India numbers were quite superlative from the perspective that when you sort of look at their e-auction realization, I mean, that was somewhere about 4.3 rupees a kg. Usually they make about 2.7, 2.8. So that was a sort of a significant jump, and that sort of led to a higher EBITDA margins and higher profitability. Uh, so number overall has been pretty good for the metal companies which have come out with. I think another thing which has sort of happened recently is that the overall steel prices have been stable in the last, after the initial fall, have been stable in the last 1 month. And I think raw material prices, like say, when you look at coking coal prices, these prices have corrected from 415 odd dollars to closer to about 210, 220 kind of a dollars. And it's a sort of a major input cost for most of the steel companies. Since the input cost prices have come down and the steel prices are sort of stable, we are seeing a sort of a good bounce in the overall metal as a pack. And on top of it, numbers and commentary is good. At best, whatever margin pressure you are seeing probably might, so over the next by Q3, the expectation is that you'll see a margin recovery happening in most of these metal companies, and which is why the buying. The challenge always is that while, say, for example, China is sort of exporting less or has exported less of late, but in case if that number goes up, again, you will see volatility in metals. So metal is always a sort of a volatile sector to sort of track in terms of variables. But as of now, things are looking a lot more brighter. I think pricing damage has a lot more done. So probably some bit of more of a pricing recovery can happen. Within metals, we like Hindalco the most.
Talking about the earnings, Tata Consumer, Trend, Tata Chemical, all these three companies declared their earnings this week. How have they been, the numbers as such, and what is your view on all three of the counters?
So when you look at all these three Tata companies in their respective segments, they have come out with one of the best numbers. So for example, Tata Consumer, the top line growth was about 11 odd percent. And when you sort of look at the 3-year CAGR, sales is in double digits for the India business. And when you sort of look at the kind of things what they are doing, so for example, while tea and salt is a fairly saturated as a segment, but you are seeing good amount of premiumization being done in a segment like say salt. Similarly, they have been acquiring or they have been sort of putting up or capturing segments like pulses, spices, healthy food. So uh, continue to grow in double digits. So from that perspective, Tata Consumer is one of the best players in the overall premiumization and food as a category in the FMCG space. Now, Trend is another company which has come out with exceptionally good set of numbers. Now, so when you sort of look at on a favorable base, we've seen 400% plus kind of a top line growth. On a 3-year basis, when you look at the revenue growth is 30%. That is quite high from that perspective. And so I think this is one company which has done exceptionally better compared to all the retailers across, and which is why this company is also has got one of the best template. So if somebody is looking at retail as an opportunity, I think this company is offering one of the best growth opportunities. Now, Tata Chemical is benefiting from number of factors. One, when you look at demand for soda ash, which is their key product, is quite robust. While domestically demand for from detergent is bit soft, which is what the commentary has been. But when you look at demand of from glass and say other segments, that's sort of pretty robust. And I think the challenges which global players are facing in terms of high energy cost, and there's no new capacity expected to come up in the next 2 years. And as a result of that, the soda ash is going to sort of realization is going to drive the overall top line and bottom line growth. So again, this is sort of a breakout quarter for Tata Chemicals, and our sense is that this company will sort of continue to sort of do well for the next 2 years because there's hardly any capacity expected to come up. So all these three companies have done very well in terms of results what they've come out with.
Let's talk about Bharti Airtel. They have just there were news reports that the company may be launching their 5G services very soon. As far as the earnings are concerned, that were also as per expectations. So, what should one do in a company like Bharti Airtel?
So when you look at numbers quarterly, you have about 4% kind of a quarter-on-quarter growth, and largely that is because the ARPUs have gone up by 3% because they had taken a previous tariff hike, and so the residual benefit of that has sort of flown in this particular quarter. Now, so the margins were also good because of the tariff hike what they have taken in the India business. Now, the key highlight for the quarter is the kind of a debt reduction what they have done largely by nearly 4,000 odd crores, largely because of the healthy free cash flow generation. Obviously, telecom, a lot of is expected to happen in future. So obviously, there is an expectation that you will see 5G launch soon, and probably it might sort of spread to most of part of the country by 2024. And we also expect there will be pricing for 5G pack, and that will determine that might imply the kind of price hikes what these companies could undertake. So obviously, a lot will depend on how things unfold probably over the next 1 week or 10 days in terms of the kind of launches, what they plan out, and the kind of pricing they come up with. Because our sense is that even companies are also sort of signaling that a price hike is on the cards.
Pankaj, talking about the financial sector, I mean, the banking space has been doing well. We are seeing private sector banks leading. the banking space and inching higher. So, do you see financials leading Nifty higher? Because you were talking about Nifty touching a new record high, say in next 3 to 4 months. Will financial lead the market this time? Because IT, we don't see any kind of attraction as of now.
Absolutely. I think IT is still not really performing to the expectation, but on the banking and financial services side, I think there are three, four major things which are sort of having a positive above. One, obviously, the credit growth has seen or has been sort of picking up. So we have seen credit growth inching up to nearly in excess of 15 odd percent. And I think management commentaries across banks is very positive on the retail side, whether it is home loan, whether it is personal loan, whether it is credit card segment. So there is a sort of a steady run what you see on the retail side and MSMEs also. And then I think companies are or banks are also guiding for a gradual pickup in the capex and the working capital limit what corporates are looking to consume. So obviously that is sort of having a positive rub-off. And I think asset quality trends are also good. So you see 6 to 35 bips kind of a quarter on quarter sort of a decline in terms of their asset quality. Or improvement in asset quality. And then I think one of the bigger fear was that you'll see treasury losses happening. And I think overall sense is that with inflation sort of cooling off, probably the worst is behind us in terms of the kind of impact what one would see in treasuries, because this particular quarter we have seen banks like Kotak, SBI getting impacted because of the losses on the treasury side. I think so. So from that perspective, banks are sort of looking positive, and I think you also need to look at FI data. I mean, FI last week typically are seeing we are seeing inflow of nearly 2,000 odd crores. In this particular month, they have put in about 18,000 odd crores. And our sense is that banking, being a proxy for overall consumption, is a beneficiary of that those inflows. So that way, I think banking will continue to sort of anchor Nifty to higher levels.
Pankaj, we, 2 3 months back, we were talking about private consumption, private investment really, picking up because government has been spending till now. It has been front loading. It has been, putting pressure on investment in infrastructure space. But private investment has been missing out, which it was expected that. In FY23 second half may see some pickup in private investments. Do you expect that to really happen? Because there's uncertainty is still around.
Yes. So our sense is that when we sort of look at the capital goods as a sector, so when you sort of see capital goods as a sector, this is one of the better or best performing sectors of late. And till last week, overall order book growth was in excess of 40%. We had ABB numbers also. So ABB witnessed a 64% kind of a growth in order inflows. So typically, the broader commentary across most of the major players is that there is a decent amount of private sector capex being lined up. The government capex itself is expected to pick up in the second half. So from that perspective, order inflow is really not a challenge. Execution has been good in this particular quarter for most of the companies, and which is why you see a YY growth for most of the players. There's some margin pressure. Some of the players are facing. Say, for example, Thermax witnessed a softer margin largely because of the previous high cost orders what they had to execute. But 1 or 2 quarters down the line, these margins are expected to improve. So our sense is that overall capital goods as a space looks very attractive, given the fact that after a long period of time, we are seeing both private and public sector capex sort of inching up. I think ABV numbers are also a clearly highlight from that perspective, and company sort of continues to see recovery in certain segments like, say, for example, data center. There is a new category which has sort of come up. You have renewables, you have electronics, food and beverages, and pharma. So these are the segments where they are seeing a decent amount of capex. And our sense is that these companies will deliver double-digit kind of a both top line and bottom line growth. And most of these companies have got healthy growth. Only challenge is the valuations are on a higher side coming from a historical perspective.
Indian hotels declared their Q1 earnings, and I remember that 6 months back, we used to tell our viewers, whoever is watching our videos, that this is the unlock trade. One should take positions in hotel sector, which you thought was going to do better, and here we have quarter one numbers, which have been very good for the hotel industry. So tell us something about the Indian hotel numbers and what is your view on this company now?
I think when you sort of look at Indian hotels, so this company is a good pointer towards what is driving urban India in terms of priorities. So when you sort of look at this, so typically this quarter is a weakish quarter for any hotel company. Now, compared, so this company has got, this quarter performance was the best ever this company has seen in the last 11 years. And when you sort of compare from pre-COVID levels to now, the room rates have gone up by 30%, the occupancies have gone up. And mind you, this is not the best season for them. So the best is yet to come for them. So in a weaker season, you're seeing this kind of a growth with 30% kind of a margins. So I think this is a sort of exceptional quarter and speaks volume about the kind of a strength in demand recovery what you see on the urban side. So obviously there is a softness what you see in the rural side, but the urban side you're seeing a pretty strong growth. And our sense is that these numbers will keep getting better as and when the international travels also sort of come to India. So next 2 quarters, according to us, will be even more robust for this company. And this company is debt free. Expectation is that the margins will further improve from 30% to 34%. And overall, with the kind of fundraising what they have already done, they are already sort of debt free. So this is one of the best plays on the urban discretionary income, and I think best is yet to come for this company over the next 3 years, and which is why we have again sort of upgraded our target price to about 330 on this stock.
Pankaj, when markets recover, the retail investors jump in again. They don't want to miss out the rally because they've already missed out on 10%, 11% recovery that we have seen in the markets. So, what would you suggest them? You know, uh, Retail investors usually want to get into mid-cap stocks. So, which are the top three mid-cap stocks that you would recommend them accumulate for longer period of time so that they get to create wealth for themselves?
Well, we have a large universe in the in the mid cap and the small cap space, but of the numbers or of the companies what we have seen recently, and of the some of the companies which I have spoken about today. So Indian Hotels is one of them. Phoenix Mills and Trend is another company which we feel are structurally sort of poised to do very well going forward. So to top of my mind, I recall these three names. Obviously, I have a long list which I can sort of will share in bits and pieces. But
Yes.
I think these three companies look good to us. And Phoenix Mill, to highlight again, so numbers were very good. This is again a company which is a sort of a play on urban recovery. We are seeing good sort of footfalls in the malls. There has been a good recovery in the rental business. And I think when you sort of look at the July also, so in July, the consumption has been robust and is trending 133% higher compared to pre-COVID levels. So that way, I think this is another company which is going to sort of do well. They've got about 6.7 million square feet of space, and they will sort of keep adding 1 million square feet of space, so nearly doubling this to about 13 million square feet of space by 2026. So from that perspective, this is a good proxy play on the entire overall consumption across premium or reasonable categories, so of various categories of consumption.
I think, Pankaj, we need to start Hidden Gem once again because now the markets are back into momentum. So we'll do it from next time. Uh, and to our viewers who are watching us, maybe we start it next time, and we'll also try and give you an insight into good quality mid cap and large cap stocks so that you will get strong portfolio for yourself and create wealth for yourself. Pankaj, one last question. What is your strategy for next week now that we have seen 17,700 on Nifty and you expect the markets to inch higher? Next week, what should one do?
So like this week, and even next week is a bit truncated. Possibility of a gap up or gap down on Tuesday is very high. Volatility could be there, and consolidation at higher levels is a possibility. And I think there are a couple of factors which one needs to watch out for. One needs to look at what is the PM speech in terms of various focus areas which the government would eventually focus upon. Then you have inflation data, and then you'll have some data on the US side, especially the retail and home sales plus the PMI data. But I think overall, if we don't see major reversal in energy prices, I think markets or riskier assets are expected to do well. And in Nifty, we see strong support at 17,300 kind of a levels, and largely we don't see big cracks unless something changes drastically. So overall, our sense is that it's a buy on dips kind of a market. And like I highlighted, if market momentum or everything is all right, probably new high could be on the cards over the next 3 to 4 months.
Thank you, Pankaj, for your time. Pleasure speaking with you as always, and wishing you and your team a very happy Independence Day.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.